We have Nuresh, we have Soni Patnaik, and also Daljit, who's joining us. Daljit, since we are talking so much about energy stocks, oil and gas, which end of the market, oil and gas and energy, if I may, bucket it like that, do you think is most under-owned by institutions, HNIs, retail? Is it the OMC? Is it RI, or even upstreams have started moving like ONGC, etc.?
Good afternoon, Ajay. I think we are very bullish on the upstream part. We have also loaded up on oil and gas sector as such overall in the last few months. And our preference was always on the upstream side, both on the gas as well as oil side, mainly because after many years, one thing is very clear that after so many years, we have seen a new discovery of oil coming in, and that production has started for ONGC now. So that itself is a very big game changer. Second thing is that when these stocks normally come out of 7, 8 years, 10 years of underperformance, they usually run for a very long time, mainly because things would have changed. Most of the previous owners would have moved out of the stock. So technical reasons are there, and then fundamental changes are happening. One thing is very clear from the government side that we've seen much less interference in these companies in the last 1 year, 1.5 year. Probably government is happy with the $75 kind of pricing for implied valuation for per barrel for the ONGC, etc. So I think that is very well accepted by the market, and that leaves good scope for appreciation in these stock prices. So I think there are a lot of changes happening in this sector. Besides oil and gas, in energy sector as such you say, then again power, renewable power is doing well, but even thermal power is doing well. Again, thermal power has seen light of the day after 10, 12 years. NTPC used to be sometime in 2008, 2010, people used to talk about it. And then for last 15, 20 years, we did not talk about it. Now, again, we are talking Coal India has come out. So I think there's a lot of change happening because of that ESG thing also, which had in between cropped up. That is gone now. Many things have come at a confluence for this sector, and that's why the sector is doing very well. Of course, the under ownership also plays its own role.
What are you seeing on the charts for Reliance? Does it seem like more of a short covering led move? And considering names like ONGC, Reliance are coming out of a long period of hibernation, what's next on the cards?
So if we look at these names, we discussed ONGC in the morning as a buy trade, and I've been discussing it how the stock has done nothing for a long period of time. Gave a breakout above 200 odd levels. It's a 5-year breakout. And the stock was one of the most under-owned names in the oil and gas pack. And this pack as such has been under-owned relatively. So the trend is just a start. And we've seen when trends start in such names, they continue to surprise. For example, NTPC, when it broke out a year and a half back, the stock has gone up 100%. And it still continues to hit new all-time highs. So continue to remain bullish on ONGC. Reliance hitting a new all-time high is generally an indication of a fresh move rather than short covering, because we see short covering after a correction. So out here, it's a fresh breakout. We've broken out into new all-time highs. Did a retest also of that breakout point 2650, which was the previous high, X of Geofinance. We did a retest and now we've hit a fresh high. So it now becomes a buy on all dips. So the whole oil and gas pack looks pretty promising. It's just that today's move makes it a little difficult to take a fresh position, but any dips of 3-4% going forward should be a buying opportunity.
I was trying to make, Anisha, was that Geofinance actually becomes free?
Yeah, I know. Apart from the time value of money, of course, but nonetheless, it becomes free for now.
I mean, I know so many people in the market who bought in the first 15-20 days.
Purely to get Geo.
And Geo Financials, I'm saying, when the demerge thing came.
Correct.
And then it did not move for like 2-3 months. So
actually declined for a long time. It was actually on the negative trend.
Promoters were buying and impatient investors
correct.
exiting. And that stock could have
And now you have the clarity also in terms of what business plan they had, because initially, of course, the big doubt was that there's nothing in the P&L for now, though a lot is sitting on the balance sheet, but that clarity has emerged. But apart from Reliance, let's not forget the contribution from L&T today. That stock is higher by 4%. It comes out with its earnings tomorrow. We'll shortly get Lisa to talk to us about the earnings expectations. But before that, Soni, let me bring into the conversation for L&T on the chart. What does it suggest? And even the power financiers, the favorites of the traders these days, REC and PFC, would you recommend accumulation on these three counters?
Good afternoon, Anisha Ajay. Thank you so much for having me on the show. So, speaking of LNT, I think LNT has also given a very good fresh breakout today, and it has crossed the resistance of 3,700, which was reflecting on the options chain data. So, I think from here, current levels, it's a good accumulation on LNT. It can head towards 3850 plus levels on a positional basis. There is a good, breakout on charts, and also the RSI positive divergence is just adding up to the positive data for LNT. On any dip up to maybe a percent, 1.5% at max should be a good buying opportunity. And the stock has seen multiple support zones starting from 3650, 3600, multiple support zones. I think so anything closer to the support will only add up to it. Talking about PFC and REC, both these stocks have seen very aggressive long built up positions today. So I think both are also looking quite good on the stock. PFC particularly 430 was the level for the breakout. It has broken above it quite strong. It can test 460 odd levels. I think one must continue to hold the stock, and anything towards 430 can be a good accumulation zone. Similarly for RAC, I think RAC is heading towards 500. It has tested, though it's important for it to close above 500. Any closing sustenance above 500, it can test 540 odd levels on a positional basis. I think better would be PFC from current risk reward ratio than RAC. So I think LNT and PFC would be a better buy.
PFC, Sony also betting on those names. In fact, Lisa is here with us to tell us what to anticipate from L&T's earnings. Lisa?
Yes, so L&T is expected to report a revenue growth of around 17%, and this is expected to be driven by orders, which is expected to be flat, but orders is largely to be led by the international orders, by the large hydrocarbon projects in Middle East. Now, talking about the margin, stable margin of around 11%, that is expected mainly on the back of development projects, but that is expected to be offset by execution of lower margin infra projects. Now, the PAT growth, that is likely to be robust and strong, around 30% on year-on-year basis, and that is on the back of financial leverage as well as lower tax rate. Now, the factors that we have to keep a watch on, that will be the ordering slowdown in the run-up to election, even the Red Sea issues, the impact of the Red Sea issues on the execution delays, that also is one key factor to keep a watch on. The divestment for non-core business for the Hyderabad Metro as well as Nabha Power, and the new business segments, that is solar, hydrogen, all are key factors to keep a watch on. But most importantly, it is the guidance, whether the management day, the guidance remains intact, and whether they stick to the guidance, because the order inflow guidance was projected at around 10 to 12% and the revenue growth of around 12 to 15%. And most importantly, it was for the core infra margin, which they had downgraded from 9% to 8.5 to 9% in the last quarter. So we have to keep a watch on all these factors, and these are the key factors to keep a watch on.
Just wanted to bring out the stock of GAIL also, because the numbers are just being reported and it looks like it's a big beat versus expectation. We'll get more details as far as GAIL's numbers are concerned, because the first number that I'm seeing in terms of the net income has come in at 2,840 crore thereabouts, which compares with the expectation of 2,282. BPCL has already been a bit of a beat on the bottom line, and seems like GAIL is likely to follow suit. And overall, the numbers do look probably better than expectation. Let's do one thing. Let's quickly head into the break while we are witnessing the reaction on GAIL stock. When we come back, we'll try and get Somit with us to talk to us more about the numbers.
So let's dig a little more deeper into the earnings quality of some of the engineering companies. Look at how Voltam shot up to 10%. The earnings just came out. Profitability has almost doubled, and a good surge coming in on revenue front as well. In fact, Daljit, I want a view from you on some of these transformer companies. Look at Voltamp right now. Even last week, transformers and rectifiers, TRIL, also shot up almost 20% after good guidance. This entire mid-tier transformer space, especially in light of what's happening in power, do you like this space? Do you have some names there, or are you playing it some other way?
We do like this space. Unfortunately, we don't have any stock right now in our portfolio from this space. We had the biggest name, which we sold off after booking good profit there. Now, basically, two things are happening here. One is that with the demand from, because what we talked about power sector as such, there is so much of demand for transmission and see, we have, for every 1 rupee of generation, you need to invest same amount for transmission also. But somehow in last 40, 50 years, we have invested a lot on generation, but not invested enough on transmission, which is now getting trying to like catch up some of that in the last 2, 3 years, 4 years. We've seen some of that has happened. With this new thrust on power sector, probably that will only increase. So demand is definitely there. Second is all these are commodity users. No, all of these guys were impacted very badly because last 1.5 years, the prices of raw material was very high. And though they have variation clause in their contracts, but they could not pass on entire thing. And the result was margins were suppressed. Now those things are behind. And as a result, the margins are expanding as well as demand is going. So double, you're getting benefit from both the sides. And that's what is exactly playing for the sector. Once these two things happen, obviously the market rewards it with the re-rating also. So therefore, this re-rating is happening in this entire sector. There are still a lot of these companies which are doing very well, and they're not very obscenely priced, I would say. Of course, they have done a lot catch up there. So maybe at this point of time, entry will require a little more deep dive into it, but definitely there is a lot of scope there.
That's the take coming in on Voltamp right now. Just want to see what the PSB basket as well is up to. You know, PNB came out with very solid set of numbers, good growth in profit despite that 800 crore rupee employee wage hike provision, good growth when it came to their retail and corporate EBIT as well, much unlike some of their private banking counterparts or even larger peers for that matter. PNB holding out quite okay. Naresh, just wanted to get your sense in on some of the charts of PSU banks, led of course by SBI, and what's your reading now on PNB?
So PNB was a favorite and has done well. Now the case is after such a move, the risk reward is not great, but the trend is pretty strong. The stock has moved up from 60 odd levels just 5 months back, but the trend is still strong. Any dips back to 103 to 105 range remain a buying case for the stock. The top pick as of now remains State Bank of India purely because it has underperformed the whole PSU banking space as such. It gave a breakout about 600, 620, went up to 660, was a failure. Now again, it has come back above the 620 levels. It should get further into momentum post 640 sustaining. So at current levels with the recent low stop loss at 600 as such, looks like a good interesting bet here. And once it crosses 640, it could surprise on the upside. So structurally, a 1 year, 1.5 year breakout on State Bank of India. So looks promising at current levels and add more on the way up above 640. The next one is Bank of Baroda, which is on verge of a flag breakout today about 235 odd levels. So that also looks promising. So the top two picks now would be State Bank of India and Bank of Baroda.
Okay, let's address what to anticipate and expect from the interim budget just a few days away. And let's get you some exclusive khabar on what we're picking up the interim budget is going to entail. And sources tell us that the Special Economic Zones Act is headed in perhaps for yet another amendment in the upcoming interim budget. In fact, let me take it across to my colleague Ankur Mishra as well and get in some more details. Ankur?
Yes, after a decision of not coming up with the Desh bill, now we understand through sources that government may tweak SEZ Act for allowing domestic companies to sell within India. Now, what does that mean? That SEZ Act will be amended to give benefits to domestic companies who are operating within the SEZ zone. Now, this amendment will allow domestic companies to sell goods and services within the country, and that has been long-standing demand to make these companies operating in terms of exports more attractive. And now we can see that SEZ Act amendment is on the way. In December 2023, you would remember that commercial office leasing benefit was given as far as SEZ is concerned, and after that their expectation was that there will be Desh bill which will come out with benefits for SEZ zones companies. But all in all, we understand now that through amendment in SEZ Act, government may come out for incentives for companies so that it becomes more incentivizing for companies to sell in domestic markets. Remember last time when this when this incentivization was given to companies, there was also one of the conditions that these companies also need to return the taxes to get the benefits. So we may see these benefits coming to companies which are operating in SEZ zones, and this will be announced as soon as in this budget itself. That is what sources have informed us.
So that's about SEZ. Thanks so much, Ankur, for bringing us those details. But it's just 2 days to that big event, which is the budget. So there are a lot of stories lined up. In fact, my colleague Prakash Priyadarshi is also picking up that there might be a new scheme for housing announced, and this might be focusing on the middle class as well as urban poor. Prakash, tell us more.
Yes, what we are learning from our sources is that the government is likely to announce a new home loan scheme in the interim budget. This scheme is going to be focused on urban poor and middle class, where the overall size of the scheme could be around rupees 60,000 crore, and the government will provide benefit of interest subvention to the home buyers that could be in a range of 3 to 6%. Along with that, sources are also informing that the home buyers can avail benefit of interest subvention on home loan up to rupees 50 lakh. Along with that, all the modalities have already been completed by the government. As you are aware that the Prime Minister has announced a new home loan scheme for urban poor and middle class, and since then concerned ministries have been working on these modalities. Some of the suggestions which have been made by the Ministry of Finance have also been incorporated in the final proposal, and we are given to understand that this scheme could be announced in the interim budget. Along with that, sources are also informing that this scheme is going to be little different from credit-linked subsidy scheme in terms of size of the houses and other benefits.
All right, so that's something to watch out for in this budget. But moving on, Daljit, I want to talk to you about this entire, the consumer durable side, especially air conditioning. We saw how Voltas and Blue Star and even Symphony to a certain extent went through a prolonged phase of underperformance, almost fell below 800 bucks for Voltas. So was another stock, Amber Enterprises, because they are a contract manufacturing essentially for air conditioning. But last week the management came out and spoke with us how they are diversifying into air conditioning of our railway system and also going into other areas. So essentially moving away from low margin contract manufacturing alone. And the management came on our channel. The stock was locked on almost 10% on Thursday, another 6% today. How do you see this, the opportunity size if companies such as Amber go towards railways and many others actually, contract manufacturing, widening their revenue mix? We'll also get you a management bite and then I'll come to you. Why don't we play the commentary which actually sparked the up move?
Since Sidwal, our railway mobility application business, we are delivering solutions in space of air conditioners, doors, gangways, and pantry systems. So we will be creating another SPV with Titagad, where we are going to bring interiors and other components. This is one of the strategic tie-up where the Titagad have their facility in Italy also. So till now, we were not having experience in the global play. We were lacking in the experience. So this venture with Titagad will also give us a global play. We've already guided the markets. Last year we've touched almost 14.5–15% of ROCEs, and in next 3 years' time we should be in the range of 19–21% of ROCE.
Okay, 19 to 20% kind of ROCE being targeted by Amber. But this entire pocket, Daljit, your thoughts?
This is very interesting, and in fact, we were waiting for this trigger, some kind of trigger to play out in this stock, because Sidwal, if you know, has been there for quite some time with this company, and they were looking for a threshold to come in the railway side of that business. I think this is a good strategy with us. Now they have tied up with another railway company. Mainly that what happens is that this will kind of hedge them against the nature's vagaries. Not the home and AC business is more related to what happens to the weather conditions. And every time we see there is a delay in weather, summer, or either there is a severe summer or less summer, and all of that keeps making a lot of fluctuations in their business. Now, this will create a hedge kind of thing, because this business project business will remain as steady business. Once you get that contract, it will remain with you and you will have to execute it over a period of time. We know that there is a lot of emphasis being given to amenities being provided in railways, to comfort being looked after, and this business is only going to increase. We did a lot of some research on this, what kind of potential, and we like 3-4 months back we did that study, and we were convinced that this potential from the railway business itself will be much larger, almost 8 to 10 times of what current business is. So and this company has been on the forefront of that. They have taken another opportunity with another railway service provider. It's a good thing. So I think there is a huge potential in that segment, and the company is doing a wise thing of spreading out to not just staying to the home ACs or to the to exposing themselves to the nature.
We'll take a short break on that note. Thanks very much for your time, Daljit. Sony and Nuresh are staying with us for some more chart checks on the other side when we come back.